Greetings, everybody. Welcome back to Strongman Personal Finance. We got another sponsored video. That's right. I got paid $50 to talk about a stunk, to look at the financial statements. And if you want to pay me $50, I'll talk about whatever you want. I'll talk about fluffing, which I do a lot for a side business. I'll talk about whatever. You just give me $50 and I'll make a video, a dedicated video. Now, I want to shout out my boy who requested that I say his name. And his name is Tyrone Titan Dick. I'm just kidding. His name's Tyrone Jackson. Just wanted to shout you out, buddy. This is the sponsor of today's video. We're going to talk about ARM stock. ARM stock, and then we're going to talk about leg stock afterwards. No, but in all seriousness, we're going to talk about ARM stock. Now, this company recently IPO'd. And there was all this kerfluffle about it. And I actually thought about making a video. But then I just didn't do it. And now I got paid for it, so whatever, I'll make it now. What does ARM do? Well, instead of me explaining this, because I'm not a chip expert, I'm going to let CNBC do this, and they'll probably demonetize me, but whatever.
Rather than make chips, the UK-based company designs the architecture, then sells licenses for these instruction sets to companies that make central processing units, or CPUs. What exactly is an architecture?
If you think about the CPU as the brain, those are the instructions, or the commands, if you will, that tell the brain what to do, how to walk, how to run, how to lift an object.
It also collects royalties on every chip shipped with its technology.
ARM is the most pervasive CPU, or brain, in the history of modern electronics. 250 billion of those brains that have shipped in our history. Over 30 billion of those brains ship every single year.
ARM's customers include Apple, NVIDIA, Google, Microsoft, Amazon, Samsung, Intel, Taiwan Semiconductor Manufacturing Company. In short, the world's biggest name.
Wow. So basically, they just collect licenses and royalties, which is actually a pretty good business model if you think about it. You sit around, you design an architecture, and then you just sell the license for it. Like, that's sounds like a highly profitable business. So if we go to stockanalysis.com, it's actually not very helpful. We know the stock just IPO'd in September, so there's no crazy price action. It's up 24% since the IPO. And there's really not much to see. I mean, there's not much data on here. So what we're going to do is we're just going to go through the financial report bit by bit, and I'm just going to give you my thoughts on everything. So the first thing we want to look at is the income statement. This is the profit and loss statement. We got the 3 months ended September 30th, 2023 versus the prior year, 2022. And then on the right here, we have the 6 months ended September 30th, 2023 versus 2022. So first of all, I'm actually a little surprised that if you look at the 6 months of revenue growth, it actually wasn't that great. I mean, they definitely had some revenue growth, but it wasn't like this explosive 10x revenue growth. The growth rate year over year for the last 3 months is a lot better, from 630 million to 806 million. But for the 6 months, it isn't as great. Okay, well, we can see their revenue consists of revenue from external customers and revenue from related parties. Thankfully, all the revenue growth looks like it's coming from external customers instead of related parties, which is, I don't even know why they have it here on the income statement. Basically, related parties, you have some like joint ownership or affiliation with somebody that you're selling to. But thankfully, all the growth is coming from external customers. That's a good thing. So revenue, at least for the year over year, has grown pretty consistently. Cost of sales is negligible. Like, this business, at least from the gross profit perspective, is insanely profitable. Because think about what they do. They just design the software, they design the brain, and then they just sell the license for it. They just collect royalties. It's kind of like me writing my book. I just collect royalties. I don't have any expenses. So insanely profitable from the gross profit perspective. However, there's some very interesting things going on here. First, R&D. We can see there's a massive increase in research and development expense from 248 to 626. Now, on the surface, you may think, man, they must be really pouring money into R&D. But there's actually more to the story. And honestly, it's stock-based compensation. That's a big part of this increase, as we'll see later on. It is not necessarily because they're spending money. If you have employees that work in research and development and you give them stock options, you would have to, theoretically expense the cost of the stock options into research and development. So that's a big reason why that's growing. We can clearly see that operating expenses have more than doubled. And the company has swung from a profit last year to a loss. Non-cash loss, however. Okay? So the company's unprofitable on the accrual basis of accounting. It's basically Palantir, but not nearly as insanely bad. Palantir back in the awful. Decades of unprofitability, massive stock-based compensation. But that's the reason why. Okay, so they're currently unprofitable, but at some point I'm sure the stock-based compensation will go away. Changes in shares, I mean, we can see a little bit of share growth year over year, but I mean, they just listed, so that's almost irrelevant. Okay, let's look at their balance sheet. So they have cash and cash equivalents of $1.4 billion, short-term investments of $800 million, and receivables of $864. So these are very liquid assets. These are assets that they're going to be able to convert to cash. Well, either is cash or they can convert it to cash very, very quickly. Their short-term debts are only $795 million. So they are very, very solid on the current ratio front. For their long-term assets, which means they can pay their bills, basically. They're not going to go bankrupt within a year. Their long-term assets, the vast majority of their long-term assets are in goodwill. Goodwill is recorded when you buy another company for more than the fair value of its net assets. That is the biggest part of their long-term assets by far. The second largest is their equity investments. Okay, these are basically other pieces of other companies that they've acquired but they don't control. Those are the two big assets on their balance sheet. Total long-term assets are $3.3 billion versus long-term debts of $1.2. I mean, I'm not concerned about this balance sheet. I'll be perfectly honest with you. Okay, the equity section, obviously, this company's so new for being publicly traded that we really need more data. But overall, an overall assessment is they're unprofitable because of stock-based compensation, and they have a pretty solid balance sheet. Now, if we go and we look at their statement of cash flows, we can see a different story here. Look at this. They have positive operating cash flow. That's right. Even though they were unprofitable, they had a loss for the 6 months ended September 30th. They had positive operating cash flow. Why is that? A big part of their expense is share-based compensation cost. That's right. It's an add back on the statement of cash flows, Joseph Carlson, because it's a non-cash expense. This is not a cash expenditure. It is added back to reconcile from the accrual basis of accounting to the cash flows from operations. Okay, they even have, it looks like, positive free cash flow. If you look at it, they have $113 million of operating cash flow, and they spent 11 on equity investments, 13 on purchasing intangible assets, and 60 on property, plant, equipment. So they have free cash flow. At least they did over the last 6 months. Okay. The rest of the changes in investments are, just buying short-term investments maturing and buying more, et cetera, et cetera, et cetera. Financing activities, really not much going on here. I mean, the company, like I said, it's so new on the public markets, at least. So, okay. Let's go ahead and look at the notes. So we already basically have a general idea of what the company does. I am not an expert in chips. I am not going to pretend to be an expert in chips. And I don't really know where this company is going to go. But they do seem to have a lot of interesting customers. Okay? A lot of big-name customers. And they have I like this kind of business model. I mean, they're not making chips. They don't really have much overhead except for stock-based compensation. I like it, okay, but that doesn't mean the stock's undervalued. Now, where does their revenue come from? Well, the United States is obviously a big part of it. The People's Republic of China is the next one, then Taiwan, then Korea, and other countries. So basically, their two biggest customers are the United States and China, or, well, whatever you want to call China, but these are both basically China. It's half and half, okay? I can kind of see why they want to reunite them together, If they did reunite, then their revenue would be the same as the United States' bro, okay? So, overall, it's the biggest customers in the United States. We can clearly see the disaggregated revenue here. Let's see, going down, contract assets, contract liabilities, equity investments. Okay, equity investments using the fair value option. So, equity method investments are companies that you've invested in that you have significant influence in but you do not control. Basically, it's if you own between 20 and 49% is like what I was taught in school. You can generally record the equity method of investments. Now, this is the fair value option, which means changes in this will probably, I believe, show up on the income statement as gains and losses. So like if a value of a security fluctuates on the market, that change in the price is reflected on the profit and loss statement. For equity method investments under the equity method, which is a very small part of their investments, the underlying profit of the business is what is recorded on the parent's income statement. So you got to understand the difference. Fair value option is a stock trading on an exchange, and those fluctuations will be represented in the income statement. The equity method is the fluctuations don't matter. It's only what's going on with the underlying business. The profit and loss on the underlying business's income statement. So that's their investments. I mean, they break it down here. Acetone Limited and Ampere. I don't know anything about them. Okay. Let's see. Financial instruments. They got loans receivable, immaterial, really nothing. Derivatives, foreign currency contracts. They're trying to hedge foreign currency. I mean, that makes sense because they have customers around the world. It's not just the United States. Let's see. Equity method investments. They cover it more here. There was a thing about stock-based compensation. Okay, here it is. There was a good breakdown that showed where all the expense came from. Okay, share-based compensation costs. A summary of share-based compensation costs recognized on the consolidated income statements is as followed. For the 3 months ended September 30th, stock-based compensation, $349 million of the stock-based compensation on R&D is from that was what was expensed under RMD. $349 million out of that number was just stock-based compensation, which is a non-cash expense. The next lowest amount is selling, general, and admin, and the one below that is cost of sales. Now, we could see that there was a massive increase in stock-based compensation because the company's public, and they did some kind of maneuver where they front-loaded or accelerated a lot of the stock-based compensation expense. I think they were able to rapidly vest the stock options. So that's why you see such a massive increase in stock-based compensation, and that's why the company's unprofitable. If they didn't have stock-based compensation, well, I'm pretty sure they would have pretty decent profits. Let's see, where is it at? Yeah, their operating expenses, yeah, they would be profitable if they didn't have stock-based compensation. So that's why they're losing money. This is like Palantir, but not nearly as bad. I still hate Palantir. So overall, I mean, it's an interesting company. Like, you know, they definitely sound like they have a moat. I'm not going to sit here and say that I understand the whole business model, but I mean, look at the companies they do business with, and look at how high their margins are, and look at the reason why their margins are so high. I mean, overall, it's an interesting company. I don't know where the stock's going to go. I'm not going to make a guess on where the stock's going to go. But from a fundamentals, I mean, looking at the income statement and balance sheet, it's not the worst thing in the world. Now, I'm sure this will swing back to profitability once they exhaust stock-based compensation. But we'll see. Maybe they'll just keep giving out shares like candy. I don't know. Anyway, I hope you enjoyed the video. Hope you learned something. And have a wonderful day. Cheers!